September 15, 2008. 7:43 a.m. Lehman Brothers, a financial institution that had survived the Civil War, 2 World Wars, the Great Depression, and every crisis for 158 years, files for bankruptcy. $613 billion in debt. The largest bankruptcy in American history. By 9:30 a.m., the stock market is in free fall. By noon, money market funds are breaking the buck. By the end of the day, credit markets around the world have frozen. Nobody will lend to anyone. The entire global financial system is 72 hours from complete collapse. Here's the punchline. The government saw this coming. They had months to prepare. They'd already bailed out Bear Stearns in March. They'd taken over Fannie Mae and Freddie Mac the week before. They knew Lehman was dying. And they decided to let it fail anyway. Why? Because Treasury Secretary Hank Paulson and Fed Chairman Ben Bernanke thought the market needed to learn a lesson about moral hazard. They thought bailing out every failing bank would encourage reckless behavior. They thought the system could handle one major failure. They were catastrophically wrong. The decision to let Lehman fail turned a bad recession into the worst financial crisis since the Great Depression. It destroyed $15 trillion in household wealth. It cost 8.5 million jobs. It nearly collapsed the global banking system. And the best part? Within days of letting Lehman die, the government bailed out everyone else anyway. AIG got $185 billion. Citigroup got over $300 billion in guarantees. So they didn't even stick to their principles. They let Lehman fail to teach the market a lesson, then immediately abandoned that lesson and rescued everyone else. It's like a parent deciding to teach their kid responsibility by refusing to help with homework, then doing all the homework for the other kids. The weekend before Lehman collapsed, the smartest people in finance were locked in a room at the New York Federal Reserve. Bank CEOs, government officials, the titans of Wall Street. They had 72 hours to find a buyer, arrange a bailout, or figure out a controlled demolition. They failed on all counts. But here's what makes the Lehman collapse so darkly fascinating. It wasn't inevitable. Right up until the last moment, there were buyers. There were solutions. The collapse happened because of decisions, personalities, pride, and politics. It was a completely preventable catastrophe. Dick Fuld was Lehman's CEO for 14 years before the bankruptcy. On Wall Street, he was known as the gorilla because of his aggressive management style. Under Fuld's leadership, Lehman dove headfirst into subprime mortgages and mortgage-backed securities. By 2007, Lehman was earning record profits. Fuld was being paid $40 million a year. Then it all fell apart. As housing prices collapsed, Lehman's portfolio turned toxic. But Fuld refused to accept reality. He kept insisting Lehman was fine, that they were being attacked by short sellers. By the time he acknowledged the problem, it was too late. After the bankruptcy, Fuld testified before Congress and was asked if he considered his behavior irresponsible. His answer? No, not at all. He got punched in the face at a Lehman gym by an employee who'd lost everything. That might have been the only real accountability he faced. Hank Paulson, Treasury Secretary, was the man who decided Lehman's fate. Paulson had been CEO of Goldman Sachs before joining the Bush administration. When Bear Stearns collapsed in March, Paulson helped arrange a bailout. When Fannie and Freddie teetered, he took them over. But when it came to Lehman, Paulson drew a line. No government money. By Tuesday after the collapse, he was begging Congress for $700 billion to save the entire financial system. Ben Bernanke, the Federal Reserve Chairman, was an academic expert on the Great Depression. His entire career had been studying how the Fed's failures in the 1930s turned a recession into catastrophe. Yet when the moment came, he helped make a decision that nearly repeated that mistake. Bernanke claims the Fed didn't have legal authority to save Lehman because they lacked sufficient collateral. But the Fed found authority to save everyone else, so that excuse rings hollow. Tim Geithner was president of the New York Federal Reserve. The weekend of the Lehman collapse, his conference room became the war room. Bank CEOs were summoned. Potential buyers were courted. Deals were negotiated and fell apart. When it failed, Geithner was one of the first to realize how catastrophic the fallout would be. John Thane was CEO of Merrill Lynch, another investment bank teetering on the edge. Thain spent that same weekend negotiating to sell Merrill to Bank of America. He succeeded, avoiding Lehman's fate by hours. Thain would later become infamous for spending over $1 million redecorating his office while Merrill was collapsing. Joe Gregory, Lehman's president and Fuld's right-hand man, was the one who pushed Lehman deeper into subprime mortgages. He believed in the housing boom with religious fervor. When colleagues warned about risk, Gregory dismissed them. He was fired months before the bankruptcy, walking away with $233 million. Not bad for helping destroy a 158-year-old company. To understand how Lehman Brothers imploded, you need to understand the housing bubble and the insane financial engineering that made it possible. For decades, mortgages were boring. You went to a bank, put down 20%, provided proof of income, and got a 30-year fixed-rate loan. The bank held that mortgage and collected payments for 3 decades. Then securitization changed everything. Instead of holding mortgages, banks could bundle hundreds of mortgages together, slice them into securities, and sell them to investors. This was supposed to spread risk. Instead, it created a machine that demanded mortgages, any mortgages, to feed into the system. If banks were going to sell the mortgages anyway, why be careful about who you lent to? This created the subprime boom. People with no income, no job, no assets were getting mortgages. These were called ninja loans, literally no income, no job, no assets. Stated income loans let borrowers just write down whatever income they wanted without proof. The mortgages got even more creative. Interest-only mortgages where you never paid principal. Negative amortization mortgages where your balance went up every month. These weren't mortgages. They were financial suicide devices. But Wall Street didn't care because they could securitize these mortgages, get them rated AAA by credit rating agencies, and sell them to pension funds who trusted the ratings. Lehman Brothers became one of the biggest players in this game. They weren't just securitizing mortgages. They were originating them through their own subprime lending division. By 2007, Lehman had over $600 billion in assets, much of it tied to real estate. The leverage was insane. Lehman was operating with a leverage ratio of over 30 to 1. That means for every dollar of capital they had, they'd borrowed $30. This works great when assets are going up. But if your assets decline by just 3%, you've wiped out your entire capital base. Everyone was doing it. Bear Stearns, Merrill Lynch, Morgan Stanley, Goldman Sachs, all the investment banks were leveraged to the sky. But Lehman was particularly aggressive. The housing market peaked in 2006. By early 2007, subprime mortgages were defaulting at alarming rates. By mid-2007, Bear Stearns had 2 hedge funds collapse. By early 2008, major banks were writing down billions in mortgage losses. Lehman kept insisting they were fine. Behind the scenes, they were using accounting tricks to hide their problems. They'd temporarily move assets off their balance sheet at quarter end through transactions called Repo 105, making their leverage look better than it was. By March 2008, Bear Stearns collapsed. The Fed and Treasury arranged a shotgun wedding with J.P. Morgan Chase, backed by government guarantees. This sent a signal: if you're big enough, the government will save you. All through summer 2008, Lehman tried to raise capital and find a merger partner. They raised capital at terrible prices, diluting shareholders. They sold assets at fire sale prices. Nothing was enough. The hole was too big. By September, everyone knew Lehman was doomed. The question was whether the government would step in or let them fail. And the answer would determine whether we had a recession or a depression. Friday, September 12, 2008. Lehman stock closes at $7, down from $60 a year earlier. Rating agencies are threatening downgrades. Clients are pulling funds. Lehman is spiraling. That evening, Hank Paulson calls the heads of every major Wall Street bank. "You're coming to the New York Fed tomorrow. We're fixing this." The message is clear: no government bailout. Wall Street needs to save Lehman itself. Saturday, September 13th. The titans of finance gather at the New York Federal. Jamie Dimon from J.P. Morgan. Lloyd Blankfein from Goldman Sachs. John Mack from Morgan Stanley. All the major players. Tim Geithner lays out the situation. Lehman is finished. They have 48 hours. There are two potential buyers, Bank of America and Barclays. But both need the other banks to absorb Lehman's toxic assets. The banks split into groups. One team digs into Lehman's books. Spoiler, it's bad. Way worse than Lehman admitted. Another team tries to structure a deal where the healthy banks collectively guarantee Lehman's worst assets. It's like asking your successful siblings to chip in and cover your gambling debts. Meanwhile, Bank of America's Ken Lewis is looking at Lehman's books and getting more horrified by the hour. The real estate portfolio is a disaster. Lewis starts thinking, why would I buy this radioactive pile when I could buy something better? Something better turns out to be Merrill Lynch. John Thain realizes that if Lehman fails, Merrill might be next. Over Saturday, Thain and Lewis start negotiating a Merrill acquisition. By Saturday night, they're seriously talking. This is a problem. Bank of America was one of only two possible buyers for Lehman. If they buy Merrill instead, that leaves only Barclays. Sunday, September 14th. Barclays is interested. They've done the work. They're ready to go. There's just one issue. British banking regulations require approval from the UK regulator, and that approval needs a guarantee from the US government. Paulson refuses. No government money. The British government says no guarantee, no deal. The Barclays acquisition dies. By Sunday afternoon, there's no buyer. The consortium of banks refuses to pool money without a government backstop. Paulson and Bernanke claim they don't have legal authority to provide that backstop. Sunday evening, Ken Lewis and John Thain announce that Bank of America is buying Merrill Lynch for $50 billion. This is good for Merrill but catastrophic for Lehman. The last possible buyer is gone. At 6 p.m., Lehman's board meets. They have no choice. The firm will file for bankruptcy. Dick Fuld, who's been awake for 72 hours straight, realizes it's over. At 1:45 a.m. Monday, Lehman Brothers Holdings files for Chapter 11 bankruptcy. 25,000 employees will lose their jobs. Shareholders are wiped out. Monday, September 15th. The market opens and immediately plunges. The Dow drops over 500 points. But the real crisis is in credit markets. Money market funds, which are supposed to be completely safe, start breaking the buck. One fund had lent money to Lehman. When Lehman filed bankruptcy, that paper became worthless. The fund's net asset value fell below $1. People panic and start pulling money from all money market funds. This creates a death spiral. Money market funds are major buyers of commercial paper, the short-term debt that corporations use for daily operations. If nobody buys commercial paper, corporations can't make payroll or buy inventory. The entire economy seizes up. Credit default swap spreads explode. The cost to insure corporate debt doubles, triples, quintuples. Nobody trusts anyone. Banks won't lend to each other. By Tuesday, it's clear that letting Lehman fail was catastrophic. The contagion is spreading. AIG is dying because it sold credit default swaps on mortgage securities and can't meet its collateral calls. Morgan Stanley and Goldman Sachs are facing runs. Tuesday night, the Fed announces an $85 billion loan to AIG, effectively nationalizing the company. So much for moral hazard. The government just rescued AIG 36 hours after letting Lehman die. Wednesday, the Treasury announces it's guaranteeing money market funds. The Fed announces unlimited swap lines with foreign central banks. Every principle about moral hazard is being abandoned in real time. Thursday, Paulson and Bernanke go to Congress and say, "Give us $700 billion or the financial system collapses." Congress is stunned. A week ago, you let Lehman fail to teach the market a lesson. Now you want $700 billion to save everyone else? The Troubled Asset Relief Program, TARP, eventually passes. The government injects capital into banks, guarantees debt, buys toxic assets. The Fed drops interest rates to zero and invents quantitative easing. It works, barely. But the damage is done. The recession destroys 8.7 million jobs. Unemployment hits 10%. $15 trillion in household wealth evaporates. If you think we fixed the problems that caused Lehman's collapse, you haven't been paying attention. We didn't fix anything. We just moved the risks around and made them bigger. The too big to fail problem is worse than ever. In 2008, we said we'd break up the megabanks. Instead, we made them bigger. J.P. Morgan bought Bear Stearns and Washington Mutual. Bank of America bought Merrill Lynch and Countrywide. The biggest banks today are larger than before the crisis. This creates the same moral hazard that supposedly worried Paulson. Everyone knows that if a major bank fails, the government will step in. So why be cautious? If you win, you keep the profits. If you lose, taxpayers cover the losses. The leverage hasn't gone away. It's just in different places. Banks have better capital ratios, but hedge funds and private equity firms have taken their place. Shadow banking is larger than ever. The derivatives that nearly destroyed AIG are still out there. The notional value of derivatives globally is over $600 trillion. Most of it is hedged and supposedly safe. That's what they said in 2008 too. We're also seeing similar warning signs. Commercial real estate is struggling as office buildings sit empty post-COVID. In March 2023, Silicon Valley Bank collapsed in 48 hours, the second largest bank failure in U.S. history. Then Signature Bank failed. Then First Republic was seized. The government's response? Guarantee all deposits, even above the insured limit. We're back to bailouts, just not calling them that. The crypto crash in 2022 showed that new technologies don't eliminate old risks. FTX collapsed because of fraud and leverage, the same things that killed Lehman. And we're building systems that are even more interconnected than 2008. High-frequency trading links markets in microseconds. Everything is leveraged to everything else. When something breaks, it'll break everywhere at once. The scariest parallel is complacency. In 2007, everyone thought we'd figured out risk management. The models said everything was fine. They were catastrophically wrong. Today, we have the same complacency. Yes, we have stress tests and capital requirements. But we also have new risks we don't fully understand. And we have the same human tendency to believe that this time is different. It can happen again. It will. The only question is when. The Lehman collapse teaches us 3 lessons we keep refusing to learn. First, complexity creates fragility. Lehman didn't fail because of simple bad loans. They failed because of mortgage-backed securities, collateralized debt obligations, credit default swaps, and accounting gimmicks layered on top of each other. Nobody understood the whole system. We've made the system even more complex since then. Second, incentives matter more than intentions. Dick Fuld wasn't trying to destroy Lehman. He was responding to incentives: maximize short-term profits, boost the stock price, collect huge bonuses. Paulson wasn't trying to cause a depression. He was responding to political pressure not to bail out Wall Street. But intentions don't matter. The incentives drove behavior that created catastrophe. Third, regulatory capture is real. The people regulating Wall Street came from Wall Street and often returned to Wall Street. They weren't corrupt, but they saw the world through Wall Street's eyes. This shaped every decision. Here's the uncomfortable truth: we didn't learn these lessons. We can't, because learning them would require changing how we structure our economy. It would mean breaking up too big to fail banks, which have enormous political power. It would mean reducing leverage and complexity, which would reduce profits. So instead, we pretend we fixed things. We passed Dodd-Frank, which has been steadily weakened. We did stress tests, which banks have learned to game. We promised never again. But the same risks exist, in new forms, waiting for the next trigger. The next crisis will be different in details but identical in structure. There will be leverage, complexity, interconnection, and complacency. There will be warning signs that are ignored. There will be a trigger that seems manageable until it isn't. If this video made you see the financial system differently, if it made you question whether we really fixed anything after 2008, share it. Because the more people who understand how fragile this all is, the more pressure there might be to actually change something before the next collapse. Subscribe for more deep dives into financial crises and the patterns that keep repeating. Lehman Brothers isn't ancient history. It's a preview of coming attractions. The next crisis is already being built. The only question is whether we'll see it coming this time.